Hey everyone, welcome back to another video on the channel. Today I'm going to be covering how to sell covered calls on the S&P 500 with a smaller sized account. So let's get straight into it. Now I made a video similar to this before and I kind of want to just do a quick follow-up video with similar content, but to address some of the concerns, and also for people that haven't seen the first video, I would also like to sort of expand to a larger audience here by making a second video. So let's get straight into it. So as you probably already know since you're watching this video, the S&P 500 is a collection of 500 separate companies, and typically you could buy this in ETF form, such as SPY is a pretty common one. And what a lot of people like to do is trade options and sell covered calls and cash secured puts on their SPY holdings. It's a great way to generate income, but the only big problem is that you have to have 100 shares of the underlying, in this case SPY, which at this price point of 561 is going to cost you about $56,000 to even be able to do that. As you can see here, I'll go to shares mode real quick. Yeah, 56 grand if you want to just sell covered calls, or even to sell a cash secured put, you're going to need over 50K to do that, which is not affordable for the vast majority of investors if you're interested in this kind of thing. As you can see, I currently have 22 shares, so I'm building up. Definitely not 50 grand worth. Got a pretty nice gain on it. But yeah, no, so that's not very affordable. So what's a good alternative? And I'm going to show you that here in just a moment. So instead of needing $56,000 to sell options on the S&P 500, here's a great alternative. SPLG, I've owned this previously. It's by the same people that run SPY. It's simply just a lower priced, smaller version of SPY essentially. It tracks it exactly, and it's simply just at a lower price, and you still are able to trade options on it. So by using SPLG, you only need 6.6K, which is still a lot of money, but compared to 56,000, that's much better. So you can see here, 100 shares will cost you about $6,600, which is definitely a lot better for the wallet. And also what's good about SPLG in comparison to SPY is their expense ratio is actually, I believe, a third of SPY. Expense ratio is 0.02% on SPLG, and check SPY again. I think it's 0.0, yeah, okay, 0.09. So even less than a fourth, which is really nice. So not only do you get a much cheaper price, you do in fact get a lower expense ratio, so it's nice. Also, just going to butt in here real fast. If you're not subscribed to my channel and you're interested in options trading, investing, all those great things, which about 80% of you do watch these videos and aren't subscribed. So if you are watching this right now and you're in that 80%, please consider subscribing. I do 2 weekly portfolio update videos, one on my big portfolio, which is this monster here, where I'm all in on the S&P 500, and a second smaller portfolio that's made for options trading that I started just recently. So if you're interested in that, as well as educational content such as this video you're watching right now, please consider subscribing. But anyways, let's go back to the video. Alright, so we're back now. We're here on the charts, and all I want to illustrate here with this point is that SPLG and SPY, they move in tandem exactly. So if there's any worries about, oh, well, it's a cheaper price, you know, is there issues with liquidity or in terms of how the price action is compared to SPY? No, it's literally identical. So here's a chart going back to, let's see, mid 2018 all the way to now. You can see SPLG and SPY are neck and neck. All their movements align perfectly. For some reason, SPLG is up a little bit extra. Could be an expense ratio thing. I think I mentioned that on my previous video. Really not sure. Regardless, though, identical movements in the underlying. As you can see, if we go back to the origin of SPLG, which I'm not really sure when that is. So it goes back really far. But once again, the point I want to illustrate here is that SPY and SPLG, they move exactly together. Like there's no difference. Oh yeah, so you can see this is where it started, hence the big difference in price action now because we don't have the full chart here. But there you go, we line them back up, it's perfectly in line. I can keep moving the chart to the right. You can see everything lines up perfectly. So yeah, all I want to say here is they move exactly the same. But let's look into actually trading options on this. Alright, so we're jumping back in here on my mini options portfolio. That way we can look at the options chain. Let's head over to SPLG and I can show you what I'm talking about. So once again, if you're interested in this strategy, particularly covered calls, you're going to need to own 100 shares. So once again, about 6.5 grand is going to get you that on SPLG. But let's take a look at the options chain. So just to start off with some, I guess, disclaimers, you could say, things that are a little bit annoying. With SPLG, they only have monthlies, which once again, there are some things that aren't great about their options chain, but the fact that you get the diversification of the S&P and you're still able to trade options in a small account, and that's covered sold options that aren't spreads. To me, that's kind of the big thing. So it's easy to, I guess, overlook these annoyances if you're just trying to sell covered calls on the S&P 500. But we can go 30 days out, and you can see you can get some decent premium. I mean, let's see. So this is 1.5% above the current price, and you're also getting paid almost 1% out in 30 days, which once again, it's on the S&P 500, so that's pretty good. That's not bad at all. 1.5% of capital appreciation, then on top of that, an additional percent almost in actual premium-based gains. And you can see that extends out. I could go to 67 days. You get $100 at that strike price, which essentially allows you a little over 3% in gains, worst case scenario, until you end up losing out on any money. Which is pretty cool. And yeah, the big concern I was getting in my previous video is that the liquidity and open interest isn't great on these contracts. And we can take a look here. I mean, while I do agree the liquidity isn't amazing, you can see the spread is really not that bad. There's about once again, there is a 5-cent bid-ask spread, regardless of the price of the option, but you can see right in between, like, you're going to get filled at this medium fill likelihood. You're going to be able to get filled instantly on these orders. When I owned SPLG for a while, I was selling covered calls. I had no issues with entering or exiting trades. So while it is a little bit annoying that there's a spread on the bid ask, just because it's a lower liquidity option compared to, say, SPY, I really don't see this as an issue. Once again, I've traded options on SPLG before, and I haven't had any problems. And yeah, while the premium, a lot of people aren't attracted to it because of the premium, but you have to remember the diversification and the safety you're getting from owning SPLG in the first place. You're not going to get as much premium as like a Palantir or a SoFi. Those are some crazy volatility companies that are, of course, going to have a much higher premium, but you're getting that diversified, lower risk underlying, and that's why you're not getting as much premium. But you're still able to do it, and that's the point I want to illustrate. And yeah, so I mean, like, once again, you can get $15 up here at the 68 strike, which is over 3% out of the money, which is really not bad at all. It's just a nice little 15 bucks you could collect on the side, which is kind of nice to have. And yeah, so once again, I mean, the open interest, 65 contracts are currently open on this. 156 closer to the money, 104. Like, I don't think that's terrible. People might have been referring to lower DTE. Like, if you go to like 4 days out, of course there's not going to be as much liquidity because there's not enough time for there to be premium on these options. But if you go out far enough to where it's reasonable that people would be owning these options, then you're gonna be just fine with the premiums and everything. Especially, once again, entering and exiting trades, no problems at all. Of course, it's not as liquid as SPY. SPY is like a trillion asset under management or something like that. Might be more like 500 billion. I'm not sure exactly, but you know, of course, there's going to be less liquidity on a smaller AUM ETF, but the point is that you can still do it, and it's covered options. You can even sell cash secured puts if you're inclined to do that. You could see once again, and this one's even tighter bid ask, so there you go. But yeah, so that's what I really wanted to cover in this video, is to illustrate that this is possible, and you can do this if you're interested, and you don't want to look into, you know, any risk on you know, trading spreads. If you're looking at potentially trading spreads on SPY instead to get a similar effect, which can be dangerous. It could be nicer if you want to just sell covered options, and this would be your gig. But yeah, that's about all. So if you have any questions, of course, leave them in the comments. I'd love to answer any questions regarding this. I know there's a lot of concerns or interest or questions in the last video, and I was there to address all of them. So if you have any right now, I'd be happy to address them. But yeah, aside from that, thank you for watching this video, and I'll see you in the next one. Goodbye.